Australian tax season is kicking off, and here's what you need to know to make sure that you are accurately reporting your crypto tax to the ATO. My name is Justin, and I am a crypto tax accountant and CPA here at CountonsheepYT, and today we're going to be covering different nuances in how crypto is taxed according to the ATO to make sure that you are reporting it correctly. The first thing to keep in mind here is that crypto is taxed as property in the eyes of the ATO. So it's not a currency, it is property. This is very similar to the US. And so what this means is whenever you dispose of crypto, that is a capital gain. So just like if you sold a house or if you sold a car, that would trigger a capital gain. Similarly, with crypto, it triggers a capital gain when you sell it or swap it. So when you sell it for fiat or cash, that triggers a capital gain based on the cost basis of what you initially purchased it for and then the selling price. But then similarly, when you swap one crypto for another, so let's say Bitcoin for Ethereum, that is also going to be a capital gain or loss. The way that you would calculate that is you take the fair value of what you are receiving, so maybe you're receiving 1 ETH, and you subtract out the cost basis of whatever crypto you are disposing. The cost basis is the initial purchase price that you paid for that asset. On top of selling crypto for fiat or swapping one crypto for another, a capital gain or loss can be triggered when you dispose of crypto via purchasing something. So for example, if you buy crypto and then you go and buy a car with that crypto, that will also trigger a capital gain or loss. Ultimately, whenever you are disposing of crypto, this generally triggers a capital gain or loss. So selling crypto for fiat, swapping one crypto for another, or spending crypto, aka disposing of crypto, all triggers capital gains or losses. Now, there is a small exception to this, the personal use exception. There's a little bit of clarity that needs to be fleshed out here, but essentially, if you purchase crypto for the sole use of spending it on personal goods or services, and it has to be less than $10,000, then you can actually avoid a capital gain or loss through the personal use exemption. So essentially what this might look like, you buy $5,000 worth of crypto, and then you use that crypto to purchase your daily coffee. That would not trigger a capital gain or loss. Again, there needs to be more clarity fleshed out here, but that exemption is something that likely applies to crypto as well. So moving on, another way that crypto might be taxed or is taxed is through ordinary income. So whenever you are earning crypto in Australia, whether that's through mining, staking, airdrops, any other type of reward, that crypto is taxed as ordinary income at that time. So what this means is if you receive $100 of staking rewards, say you're staking Ethereum, that $100 is taxed as ordinary income at that time. And then later, when you sell that crypto or otherwise dispose of it, whether you swap it or spend that crypto, that is going to trigger a capital gain or loss. So let's say, for example, you receive $100 of staking rewards. Later, ETH pumps and you sell it for $150. You will then have $100 of ordinary income and $50 of capital gain. Similarly, let's say you got that $100 Ethereum reward and then you sell it for $75. Then you'll have $100 of ordinary income and $25 of capital loss. So that is how crypto is taxed in terms of capital gains. That's whenever you're disposing of crypto, and then ordinary income whenever you are earning crypto. Now, let's talk briefly about what types of cost basis methods are allowed in Australia. So the primary method is FIFO, which is similar to the US. And then of course you can use specific identification as well, where you specifically identify each tax lot that you are disposing of. So what this means, and if you haven't heard of these before, take for example, you buy 3 Ethereum, you bought one in 2017, one in let's say 2020, and then one in 2024. And then you sell one of those Ethereum. Which one did you sell? Well, your cost basis method is what will define that for you. So if you're using FIFO, first in, first out, that means the 2017 Ethereum is the first one that is going to be sold. So whatever cost basis you have on that, that is the cost basis you'll use to calculate your capital gain or loss. Specific ID, on the other hand, allows you to analyze those 3 Ethereum and then pick which one you want to be disposing of. Now, it's important that you are doing this prior to the sale. This is technically what the ATO wants, is for you to identify prior to the sale which Ethereum you are selling. Now, you can utilize other methods like HIFO or LIFO or optimized HIFO, for example, through the lens of specific ID. So HIFO is generally what most investors consider to be the best method, and that is highest in, first out. So that means it would look at the 3 Ethereum, pick the highest tax lot, the one that will result in the lowest capital gains, and say this is the one that is being disposed of. Now, this is beneficial to the investor because you're going to pay the least amount of tax on that specific sale. However, you need to be doing that through the lens of specific identification. Now, when it comes to long-term versus short-term, what is the difference there and how are they taxed? Well, long-term gains are whenever you've held an asset for over 12 months. So going back to those 3 Ethereum, they would technically all be long-term except for maybe that 2024 one. If we haven't, if it hasn't been 12 months since then that would be a short-term capital gain or loss. And long-term is very beneficial in Australia, meaning if you've held an asset for over 12 months and then you sell it in Australia, it's very beneficial because you have only 50% of the capital gain to pay. So if you just made $10,000 capital gain, you'd only have to pay $5,000, or you'd only have to report $5,000 of income that you would actually be paying tax on. So very beneficial to hold your assets for more than 12 months before you sell them in order to trigger that 50% discount, more or less. So that is the primary ways that crypto is taxed. There are some areas that still need further clarity and guidance from the ATO. For example, liquidity pools and whether or not when you provide liquidity into a pool and then receive an LP token, does that trigger a taxable event or does it not? Areas like that require a little bit more clarity from the ATO, but the high level here is that whenever you dispose of crypto, whether it's selling it for fiat, swapping one crypto for another, or spending it, that triggers a capital gain. There's a small exception for the personal use cases where you've purchased less than $10,000 worth of crypto specifically to be used for personal goods and services like your daily coffee. That might be exempt. And then the other way is ordinary income, whenever you are earning crypto, so rewards, staking, airdrops, anything of that nature would be considered a reward. That's taxed as ordinary income at that time. That amount you report is the cost basis for when you later sell it, and then you'll have a capital gain or loss depending on the price movement from that point. And then your cost basis methods available to you are FIFO and specific identification, which is similar to the US. And then the long-term rates are very favorable in Australia. You essentially get a 50% discount on any gains that have been held for over 12 months. So that's how crypto is taxed at the high level in Australia. And if you need any help with your crypto taxes, we are CountonsheepYT, a crypto accounting firm specializing in crypto tax. We work in the US, we work in Australia, Canada, most major nations. So if you want help with your crypto taxes, definitely contact us today.